Welcome to the Bloomberg Intelligence Industrials Analyst Call. Today is Friday, March 8th, 2024. I'm your host, Christina Fury.
I'm Chris Cellino, covering U.S. machinery.
Mustafa covering industrials with a focus on electrical equipment.
I'm Karen Ubelhart, covering large cap U.S. industrials.
So it's been a minute since we've all been together. We've been doing a lot of traveling. There's earnings since we last talked. So we have a lot of things to cover. Let's start with Chris. I know you were at the Commodity Classic out in Houston. First of all, what is it? What's the Commodity Classic? And then maybe give us some key takeaways that you had.
Sure. It's a show by farmers for farmers, to keep it brief. So we met with most of the ag equipment OEMs down there, as well as a number of farmers and market participants. And I'd say we I think, walked away with two takeaways from the show. One, this was a big show for new product launches, specifically on the large ag side, and really kind of just reinforced our view of Deere as really the undisputed tech leader, but also kind of gave us a little better visibility or confidence in some of their long-term targets, specifically their 10% recurring revenue goal and their fully autonomous farm system by the end of this decade. So we have a little bit better visibility there. And then two, I'd say, even with like this, pretty impressive rollout of new larger equipment, we're, I'd say, increasingly cautious on the farm backdrop heading into 2025. We heard from a number of market participants, including the USDA's chief economist, and I think the tone was somewhat subdued, I'd say, universally throughout the conference, just with, expectations of broadly lower crop prices this year. You have, increased supply, relatively muted global demand, and then also greater competition from South America. And then we also have elevated input costs, so which is going to put further pressure on farmer margins and ultimately their appetite to go out and buy new equipment. But from an equipment perspective, the equipment continues to get bigger. Deere unveiled 4 new products, which I think is like one of the largest product rollouts they've had in their 187-year history. One was their 9RX tractor, which is up to 830 horsepower, which is the largest in the space. And this is essentially an autonomy-ready tractor. They also put out a new combine, air carts for improved seeding, and then they also launched their See and Spray product on Hagie sprayers. So we think that's where you could see some of the early signs of some of their recurring revenue. See and Spray, they've got 3 different categories or levels of that product, but essentially the premium product is the middle of the road, and we got a little better visibility on what the subscription aspect of that be. So there's a one-time upfront fee for the hardware. Again, that middle of the road product is roughly $25,000 up front, but then on a per use or per acre basis, you're going to pay $1 for fallow ground, $3 for corn, $4 for soy, and $4 for cotton. So we're finally kind of starting to see, like I said, just a little better visibility on how we get to that 10% target by the end of 2030.
Great. It sounds like it was an exciting show and a lot of equipment to see. And so you mentioned the farmers are, a little more muted in the view after coming out of the show. How do you see this cycle for ag being different than maybe past cycles?
I don't think it's going to be different. Shocking. This cycle will be similar to the last one. Historically, we've seen, and specifically on the large ag side, you've seen, particularly in the first year of a downturn, you have sales down roughly 10 to 15% on average. The first year of a downturns don't last 1 year. I don't expect this to be a 1-year downturn. So we're thinking demand is going to be down kind of in that 15% neighborhood across the industry. So, and I think expectations, really consensus expectations for 2025 are relatively flat earnings, relatively for Deere, CNH, AGCO. So I think there's probably some risk there, just given that, you know, farm income is going to be down, I think 26% this year. Crop prices really haven't shown any signs of stabilizing yet. So I think farm incomes are going to be under greater pressure this year. It's just going to cause farmers to, you know, pull back a little and pump the brakes. And then obviously this being an election year, I'd expect, you know, further kind of apprehension and uncertainty, just given the geopolitics involved. So I think next year ends up being another softer year. So again, not that dissimilar from prior cycles. You know, this year's all indications are shaping up to be very similar to that. You know, like I said, 15% decline, and then probably a little bit more downside risk as we look into 2025.
Great, thanks. And Mustafa, you've been traveling too, first in the US, welcome, and also to GE Vernova's Investor Day as they prepare to spin off from GE Aerospace. What were some of the key takeaways you got from visiting the event?
Sure. Yeah, I spent the week attending events here in New York and also talking with clients. And one of the most interesting days was the day of the GE Vernova Investor Day. So GE is breaking into two after the healthcare spin-off. And one of the businesses which I'll be focusing on will be the power generation business. The good thing about that is they gave us some information about their outlook. They gave us some new financial targets, which we found a little bit on the conservative side. There, of course, it's understandable after some of the challenges that the company went through. You know, you've been following the company, Christina and Karen, of course, and you know that they've been on a lean journey for a few years now. But we think there is a lot more to come, and there were some positive surprises in terms of even the legacy power turbine businesses, how much room there is to improve the production facilities. Only 40% of the lines, the production lines in the power generation turbine segment, are using lean processes, so a lot more upside for margin from there. So we put out a note on the company's targets. Management thinks a mid-single-digit organic growth for the next 3 years or so. They said by 2028 we want to achieve these targets. We think that there could be some upside to growth from wind. They've been a little bit selective on the projects because of the losses that they suffered in offshore wind, but there is a lot of demand for wind power generation. If you're going to achieve our net zero carbon targets, a lot more of the power generation should come from wind. Also, upside comes from demand on data centers. Data centers in the US consume about 2% of total electricity generated today. Management said they expect that to go up to 7% by the end of the decade, which was a positive surprise as well, although somewhat expected given all the investments these days. And then on the margin side, we see a lot of levers. I mentioned the lean processes, wind, and the electrification grid side of things. They're earlier in their lean adoption compared to the turbines, but even the turbines, they have a lot of runway still. And management said they expect to see high single-digit EBITDA margin at the end of 2025, and then 10% by 2028. That implies very little margin expansion in 2026, 2027, which we think is again potentially conservative. Maybe I'll stop there and can talk about other topics, and I'll give the floor back to you.
Yeah, so you mentioned data centers. I think a lot of your companies are impacted by data centers and the boom that they're having in construction in general. Can you just give us a little bit of an update on maybe where you think the infrastructure market for data centers is, and is there anywhere that it will slow down?
So that's one of the questions I've been getting from clients this week. Data centers have been very, very hot. A pure play infrastructure provider, Vertiv, they make uninterruptible power supplies and cooling solutions for data centers. They have been on a tear last year, up more than NVIDIA was actually up more than 300%. So of course the question is, is this market running too hot? Consensus expectations are for about 20 to 30% earnings growth for that company, and I think it's probably justified given how big the backlog is, and the orders were a positive surprise in Q4. So it seems like the demand is there. Another piece that we put out last week looked at the capital spending from the hyperscale providers like Meta, Google, Microsoft, and the expectation is their capital spending will grow more than 30% this year after growing 20% last year, so on tough comps. A lot of that will go to IT hardware, but we think our companies will also benefit. And another last positive point on that came from Eaton when they reported their earnings. Their Electrical Americas pipeline was up more than 20% last year, and we get the impression that most of that was attributable to data center spending. The potential limiting factor here could be supply constraints, especially from the construction side. There, boots on the ground, construction labor. We're sort of running to the limits of that. And of course, power availability is going to start to become an issue soon. And ultimately, this will all depend on whether AI succeeds on the demand side, on the adoption side. We don't see any issues with that yet, but that is always a question mark too.
Great. So I know, Karen, some of your coverage also is impacted by the hot data center market and also the infrastructure around it. A lot of stimulus packages from the Biden administration have been funding these projects. Ashtead reported their earnings this week, and they're a beneficiary from everything that's happening. What was maybe some of your key takeaways from their results? And we'll start there.
Okay. Ashtead is a company that doesn't really miss, and this is the second quarter where they missed. So the first quarter they were only whacked 3%. This time they were whacked 9%. I don't think the longer term story has really changed. They're having some one-offs that are I think Ashtead specific, and one of them is they made a big investment in a film business, got one good year, and then they had the two strikes. They're still coming back from that. That's in Canada, but it affects other regions like the U.S. and also not just the U.S. mainly. And the other thing is tough comps on some emergency response, which I always do not like that because it feels like an excuse, whatever. But the backlog of business is explosive, and it is all related to the government money, but also private money, like on reshoring. And they give us an update on the large projects just to see, the growth rates, et cetera. And they define them as greater than 400 million. There's 455 large projects over 400 million in the US underway or will be underway by the spring. So this isn't projections. This is stuff that's on the books. They did say some got pushed out into 25, about 40 of them, I think, but they still have their plate full with the ones that are on the books. Market share for the large rental guys is 2 times their normal share. So they're saying they're about a 14% market share in the US, and they're getting about 30% market share of the rental opportunity in these big projects. So the opportunity is enormous. I think some of the problem with the stock is that, they are ones that don't miss. They've completely lost their premium. But the other thing is that I think they are having some trouble ramping up. There's labor shortages. We know that. That's not anything new. And their fleet buying is pretty normalized now, so they are getting the equipment they want. But a lot of these projects take longer to ramp up. They last longer, but they take longer to ramp up. And I think that's a factor as well. They're going to have their analysts have their Ashtead in April, and in the U.S., because 95% of their business is in the U.S., and they're going to set new long-term goals. Their long-term goals are under the umbrella of Sunbelt 3.0, and they're going to come out with Sunbelt 4.0, and there's going to be some good things in there, but they've sort of hinted that they're also going to lower their long-term growth rate, which is never a good thing. So I think they've been signaling a little bit of that. I continue to think over the next even 3-4 years that there's just an enormous opportunity, and there's really only 2 or 3 rental companies in the U.S. that can handle projects of that size. So, I think it still has a very favorable outlook, but there certainly is noise in the near term.
Great, thank you. And it sounds like the overall mega projects opportunity is big for everyone involved, which is multiple companies that we all cover, right?
And I'd say the one cloud that's hanging a little bit over the is the election, and people will start focusing on that more, because if we get a Republican everything, where would they cut? And there's some pretty attractive tax credits. There's, the money if the money isn't in your hands, it isn't in your hands, and there could be some adjustments, on that front. I think the infrastructure bill is probably pretty safe. That was a bipartisan bill. Everybody liked it. I also think some of the tax credits, like on the wind power, for example, they should probably hold all right, but there might be some trimming around the edges on some of the IRA, because it's climate related, and the other party is less positive than the Democrats are on the need to fix our climate. So there might be some pullback on some of the money that goes into that. But overall, there's enough business to keep the rental guys busy for sure. And I don't think they'll take away the home tax credits, which help the HVAC guys. So I think they're another group that'll still be okay, because those credits are obviously consumer related, and that they're a big opportunity for heat pump growth and other things. But that's one thing hanging over the group around the whole big money spending. But I think there is some risk, but I would characterize it as moderate if you look at the whole picture. The pie is big.
A similar story, I would say, for the electrical equipment side. If Donald Trump wins the presidential race, but the Republicans don't win, both branches of Congress, there could be some executive orders, particularly targeting EV tax credits, because lately electric vehicles have become a bit of a political storm, because the lithium or the nickel that goes into a battery tends to come from China, and there is a lot of incentive to sort of try and block that and put up trade barriers against China. So that is one thing that we're watching, and I think automakers will probably jump on the opportunity to slow their ramp up of EVs, right? Because their margins are lower for electric vehicles. So some of the big projects that will benefit all of our coverage pretty much, they could get pushed out or downsized, potentially canceled, but I think that's a lower risk. Over time, I think in the long run, the direction is quite clear. We're going to move towards EVs or plug-in hybrids in the interim. It's just it could take a bit longer than expected. And Ethan was saying only a fifth of the mega projects have broken ground, which, depending on how you look at it, it's a great thing, because there's a lot more to come. But then it's also risky because they haven't actually made the bookings, right? The orders are not there yet. So could read it both ways, I guess. But speaking of electrification, Christina, I'd like to ask you about your coverage and the small equipment makers, and what's going on with the electrification of handheld equipment, or your coverage within Stanley, Toro, and Snap.
Sure, thanks. Electrification is definitely a big trend in the lawnmower, hand tool, outdoor gardening space right now. California's law just went into place beginning of this year. So now manufacturers cannot make mowers with any emissions, right? It has to have zero emissions for small engine equipment. I think there's a lot of room for growth for the OEMs in this space because only about 10% of the large format mowers are electrified right now. So it's a big tailwind. Consumers will definitely are kind of the early adopters because it's easy to use a battery powered piece of equipment, and people are concerned about the environment, whereas professionals are a little more hesitant because it changes their whole workflow, right? You have to learn how to build an entire fleet of electric equipment now, and how are they going to charge it? But there are incentives, state incentives that are happening to help the professional lawn care experts adopt. And golf is actually one of the customers that have been bucking this trend. As you can guess, being on the lawn for a golf course and being able to mow it at all different times and letting people actually golf in between, because there's a benefit of battery powered equipment is that it's quieter. So that's a huge incentive for superintendents of golf courses. So they're more likely to adopt battery powered equipment versus maybe your traditional landscaper that you might see. So I think there's a lot of opportunity there in that space. I'll be continuing to watch. Toro is a company that they actually just reported earnings yesterday. They will benefit from the electrification trend. However, they are going through kind of a tale of two markets right now. So underground and golf are equipment and markets that have a booming demand, and they can't keep up with it. Supply chain's still a little bit lagging there. And then on the flip side, the lawn care equipment has been a little slow in destocking because they had such a huge boost during the pandemic. And so earnings were they were kind of expected. It's going to be a little bit of a down year, but I bet long term there's a lot of potential for growth.
Great stuff. And it's a pretty sizable market too, right? Over $20 billion.
Yes, the outdoor power equipment market, yes, globally.
Good stuff.
Well, thank you all for your time and all the great insights. And have a great weekend, and we'll talk soon.